So hello, everybody. Good morning, good afternoon, wherever you are. I'm Michael Haliassos. I'm director of the CEPR Network on Household Finance, and it's my distinct pleasure to be here and opening this session and welcoming you all, both the people here in presence and the people online, and of course, above all, the organizers and the speakers in this session. Let me say why we are here. We are a European network. We are very active, and we've been very active in the literature on household finance, in research in household finance. And as a CEPR network, we have been operating since 2015 as a collection of researchers, organizing joint conferences, etc. We have been operating since 2010. We are here in Australia because we want to bring European research, household finance research to Australia, but primarily because we want to establish links to the very vibrant household finance research environment here in Australia. We know you have excellent researchers. We know you have excellent data. You have a big set of problems that we share, and some problems on which you have a different perspective or different ways of thinking about them. And we want to learn and we want to interact with you. So we want to encourage you very much to be in touch with us, to be attending our conferences, to be submitting your research, and to be interacting with us. This afternoon is an event that we normally organize in advance of the night before or the evening before the research conference, and that's an event on to involve policymakers and practitioners as well as researchers, an event that cultivates interaction between these three parts. We are a research and policy network, and of course CEPR's objective is to provide and integrate research and policy, to provide research-based policy advice. So these events are extremely central and crucial to us. I know the more I talk, the less the speakers get to talk, so I should shut up very quickly, but I want to especially thank our hosts, Monash Business School, that is hosting this conference and is funding the larger part of it. I also want to thank the co-sponsors, CEPR, of course, but also London Business School, EDHEC Business School PhD program, and Queen Mary University of London, who are co-funding this conference. And without further ado, I want to give the floor to Sebastien Betermier, who organized the session and who will be coordinating the panel.
Well, thank you. Thank you, Michael. Thank you, Kaveh. Thank you, Monash University and the CEPR for organizing the panel and bringing together such great panelists. Today, we're going to be speaking about the Australian retirement system. In particular, the decumulation phase of the Australian retirement system. We'll talk about the key challenges going on right now, the innovation going on as well, the regulatory framework put in place. It's an opportunity to understand the system as a whole. It's a remarkably sophisticated system, it's a super system. It is also an opportunity for all those of us doing research in household finance to look into a number of possible research topics that are timely, that are relevant, and potentially can have a significant impact on millions, the well-being of millions of individuals, senior individuals, through retirement in Australia, of course, but also beyond, because these decumulation problems, we're facing them right now quite a bit in Australia. but other DC systems are going to face or are facing the exact same questions. So we have the privilege of having three outstanding speakers with us today. We have to my left, Hazel Bateman. Hazel is a professor in the School of Risk and Actuarial Studies at the University of New South Wales in Sydney. Hazel is also the chief investigator and the deputy director of CEPR. CEPR is the Australian Research Centre for Population Aging Research in Australia. We have Jeremy Duffield with us here as well. Jeremy is the chairman and co-founder of CEPR. CEPR is a digital advice platform for super fund members. Jeremy is also the chairman of the Australian Centre for Financial Studies, and he's well known for having founded all the vanguard operations here in Australia and throughout Asia. And then in the middle, Deborah Ralston. Deborah is a professorial fellow here at Monash University in Melbourne. Deborah is also a member of the Payments Systems Board of the Reserve Bank of Australia, the central bank. She's also a member of the steering committee of the Melbourne Mercer Global Pensions Index, and recently spent time actually on the panel of the Retirement Income Review that we'll address partly throughout today's session. So the way we're going to work, we have time today with us, so we'll spend about an hour, maybe a bit more than an hour, to just discuss. I've prepared a few questions for Hazel, Deborah, and Jeremy. And then afterwards, we'll have time for Q&A, direct interactions, both those of you joining us virtually as well as those of you in person. Those of you joining us virtually, you'll have to raise your virtual hand and we'll call upon you. It's also a great opportunity as well for Hazel, for Jeremy, for Deborah. If you have questions, we have a lot of brain power virtually and in person actually on the questions of household finance. And so the more of a two-way interaction we have, all the better. So please feel free if at the end you have questions for the audience too. All right, so we'll begin by doing, and we'll put the slides on, please. We'll begin by doing a quick overview of the pension system in Australia so that we can all be on the same page. The Australian pension system has three pillars, starting with a pay-as-you-go pillar. Pillar one, that's called the age pension in Australia. It is a taxpayer-funded scheme, very much of a pay-as-you-go type of system. It's a system that gives you an income stream all the way until death, is means tested, which means that the exact amount that you'll receive depends on your income and overall assets, your ability to live. And it's a system where typically you tend to get more as you age. So if I recall, it's something along the lines of 42, 44% get it around the age of 66, but it goes up all the way to 80% when you're at the age of 80. So that's pillar one, and it's a pretty important pillar, as we'll hopefully see soon. Then we get to pillar two. Pillar two is very much the superannuation guarantee. These supers it's a system that was founded in 1992. Essentially, it's a mandatory savings scheme where individuals are going to invest in pooled defined contribution funds, very much industry funds, but you have the choice of going to another super if you wish. The contributions are fairly high. We're talking about, was it 10.5% right now of income? They're paid directly by the employer. And then you can always do voluntary contributions as well as an employee, right? And so you have these large supers that are created that accumulate wealth on your behalf. And that makes up your pillar two. And then you have pillar three. And pillar three is any additional savings that you might have. So you have any type of financial wealth, housing, that becomes your individual types of savings, right? So it's a system that has a social security net and some longevity insurance through pillar one, mandatory savings through pillar two, and then the flexibility of doing whatever you want through pillar three. What's interesting is when you're looking at the system, you have projected income replacement rates. Typically, they're high. I mean, they're about 75% of income, roughly speaking. That's consistent across the income distribution. But the composition of that depends very much on your income. So for the bottom 50% of your income, if you take individuals in the bottom 50% of the income distribution, the age pension pillar one dominates. It's big. If you look at the next 40% of the income distribution, Pillar 2 dominates. And if you look at the top 10%, that's when Pillar 3 really takes in. Did I miss anything? Anything you'd like to contribute to that description of the system? Again, to get everyone on the same page.
Okay, I'll just say something. So Pillar 2, we have to remember that there was already superannuation coverage before it became compulsory. So about 50% of workers already had some sort of superannuation, and a lot of it had been defined benefit. But in Australia, defined benefit meant you got a lump sum at retirement, and you could convert it to a lump sum at retirement, so which many people did. So I think that's important to remember when we're looking at the system as well.
And it's worth mentioning that in that third pillar, a very important part of that is household savings. In Australia, particularly given that over 80% of people own their home when they retire, and we've had tremendous asset price inflation here, that's a very significant part of people's wealth. And given that our compulsory superannuation system is still relatively immature, it's going to be some years yet until people have received substantial, have contributed a substantial amount towards their super. For many people, the wealth they store in their home is 3 or 4 times what their superannuation balance is. So increasingly, people are thinking about that third pillar.
For those who work on household finance, I think it's very interesting to recognize the role of choice in the whole program. Sebastien mentioned that you can choose the fund that you invest in, but you can also choose the investment options that you use to save and build up your retirement wealth. And you can also opt out of the traditional institutional super funds and create a self-managed super fund where you're the trustee of the program. So there's a high degree of choice and a high degree of responsibility on the individual's shoulders. And I think that makes it a very interesting market. And I've got to compliment Sebastien on getting his arms around the system so quickly, because it is a pretty complex system. In fact, it's really complex. In fact, for Europeans, I think it's sort of equivalent to coming out to Australia and meeting kangaroos or platypus for the first time. You think, what the hell is this? And the more you get to know it, the more complex you recognize it is. And I think we also have to recognize it's a bit of a political football. So it gets bipartisan support in that everyone in the political realm sees it as a key part and a key platform of Australian economy. And it's a very big part of the Australian economy. But the way it should be done and the way it should be implemented, views on that vary, and they change with government. So there's a lot of change. They used to say it changes on the cycle of the moon. So quite frequently.
Okay, I'm going to add something. So yeah, Jeremy mentioned that there was a lot of choice, but there's also a very interesting choice architecture under which it's very easy to be disengaged. So there's a compulsory contribution, but it doesn't come out of your salary. Your employer pays it, so you don't really see it. Until recently, you didn't have to choose your fund. You were just defaulted into a fund. You don't have to choose your investment allocation because we have something called My Super. And so you can basically be disengaged right through retirement. You actually don't have to convert from accumulation to decumulation. So one of the challenges is trying to engage people, because people can go through their life and not really interact with superannuation. We've all got so much to say.
I think I was supposed to say here too that there is something like a fourth pillar as well, and that is what we call the payments in kind to people of retirement age over the age pension eligibility. That's healthcare, aged care benefits, tax concessions, a whole range of benefits to assist in their standard of living. And it's not insignificant. If you added up and averaged it out, everybody over the age of 65 would be getting roughly the equivalent of the single age pension in benefits that are not actually monetary benefits. So that's a very generous system.
Yeah, please.
Sorry, yeah. Sorry, on the third pillar, you mentioned household savings, etc. Are there tax deferred individual retirement accounts that people can use?
Well, I think one of the greatest contentious points at the moment, because we've had such asset price inflation, that actually in the assets test for the age pension, your home is not counted. That creates an incentive for people to overinvest in homes. And something like 15% of age pensioners have homes worth more than $1 million. So it's a contentious point, particularly as the cost of housing has gone up. There's a real direct inequity between homeowners and non-homeowners.
So let's talk about the issues in the system. In particular, let's talk about the decumulation issues. And maybe I actually don't need the clicker. If you can just put the slides, that might just work, and I'll tell you where to go. One of the key things is that once you enter the decumulation phase, you have to withdraw. So there's a minimum level of withdrawal that is required. That minimum level increases with age. It's not a default level, it's a minimum level. The issue is most people stick to the minimum level. So if you look at it's an interesting study. I'll show you a chart whenever we can have it. You can see that the majority of people withdraw exactly the minimum required by the government. So we're talking about, what is it, 4%, 5%, 6%? It was even lower recently because it was reduced by about 50% even before the pandemic and afterwards. Now, think of that. You withdraw 4%, but you gain 6-7% on your portfolio because it continues to be invested in all kinds of high return yielding assets. That means that over time you age, but instead of decumulating, you're continuing to accumulate. So there's some interesting studies that track cohorts, and you can see that over time, as they get older, actually their assets go up, which goes against a bit the concept of life cycle theory, where once you enter the phase of retirement, I mean, that's what you saved up for, right? You're supposed to use that, but actually we find that most people do not withdraw enough. And perhaps that's a choice, that's fine if that's the case, but the issue is they end up living poor, dying rich. And so that's one of the big issues. Perhaps, can you elaborate in your view on how important that issue is? And
Thank you. I guess this is a direct outcome of having defined contribution system, where we talk constantly about how much you put into super, how much you make in your super fund, and super funds tend to give the balance to people on an ongoing basis. So the focus has been on accumulation. And when we did the retirement income review 2019-20, we did a lot of modelling to show that increasing contributions is nowhere near as beneficial as learning to draw down the money you have actually saved. People have a view that it's a nest egg and that you might draw the interest or the dividend, but you don't touch the capital. And the outcome of that is, of course, if they live poor, but also they're not spending money in the economy, which is not good. And it also means that taxpayers end up subsidising with tax concessions those unintended bequests that arise because people aren't using their income as is intended.
Okay, so I just want to clarify something that Benjamin's just said, Sebastian's just said. So at retirement, you can choose what sort of benefit you want to take. You don't have to take this drawdown, but the benefit menu available is actually quite small. And so you could take everything if you wanted. You could take a lump sum. You probably wouldn't because it's tax preferred when it's in the super system. So you wouldn't really want to take it out of the super system to some extent. You can take what we call an account-based pension, which has these minimum drawdowns. I guess they're not compulsory, but you need to take this minimum drawdown for your assets to get tax concessions. Or you could buy another sort of product. And one of the issues in Australia is that these other sorts of products, the menu has been very small. So we have life annuities. Over the last 20 years, the number of providers has fallen dramatically. So I first started looking at life annuities in the 90s, and I think there was probably over 30 providers. I was researching for this and I Googled annuity market in Australia, and I could really only find one major provider and a couple of others. So there's not a lot of products in the market, but there's an awful lot of products sitting on the shelf, because there's consultants and there's financial institutions that have been designing all sorts of products. My colleagues in the School of Risk and Actuarial Studies spend a lot of time designing products, but the actual market for them is very, very small. So most people take account-based pensions, and my view is it's the path of least resistance. So it's almost like an effective default. You can stay in your superannuation fund and convert your accumulation to a drawdown phase, which is an account-based pension. Now, these are generally invested in like balanced funds, like in the accumulation phase. And so you end up, your account grows because the rate of return on those for many years in Australia has been higher than the minimum drawdowns. And I'll now pass to Jeremy, otherwise I'm just going to say too much.
It's a great topic, isn't it, Hazel? I always use a sort of a personal anecdote to explain why I think it's so challenging for consumers to deal with this issue of how much they should spend down. I look to my mother, who was widowed at 52 with a moderate inheritance, and she had to work out how much she could afford to spend, and in the face of two great uncertainties. How long was she going to live, and what would investment markets do to provide her a return? That is an incredibly complex challenge for an individual to work out. I think Bill Sharp has called it the most difficult challenge he's faced in financial economics. So it's a really tough thing to expect individuals to work that out. And my mother, like most people we're talking about, face that uncertainty and underspend. They don't realize they can afford to spend more than they do. They take the precautionary step and underspend and end up leaving it to their kids and their grandchildren. And that's just a very natural human response in the face of a very complex situation. We just don't know how long you're going to live and what you're going to earn on your investments.
So let's talk a little bit more about that point. Why don't they withdraw more? Is it the precautionary savings motive that you've described? Is it the fact that there's longevity and there's a fear of outlasting your savings, and so we don't spend? Is it the fact that the age pension itself, it's means tested, it's volatile? Well, it's not volatile, it's means tested, and so it's hard to predict exactly, and so it creates a little bit of uncertainty about how much I'll be able to consume from pillar one and whether it even exists in the next 10, 20 years? Is it the fact that we're so used to accumulating capital in the system that we don't really know how to convert it into income? What, in your view, is explaining these low withdrawal rates?
I think they're probably all of the above, but I'll start with just the complexity of the mathematical challenge. What average person is going to be able to work out how much they can afford to spend without access to advice or access to calculators that will help them? If they don't find those resources, how are they supposed to think about that problem, which is an advanced mathematical problem, and particularly difficult in Australia, where we have this very odd means-tested age pension, which means that your age pension amount varies depending on how markets do. And so it's a dependent variable, dependent on what your assets and your income do. So it's just an extremely complex calculation to work out. And we have a complex system where there's a lack of advice available to help people at affordable costs. So I think people are poorly informed, and they look at the government guidance in the minimum withdrawal rates as an anchor rate or a reasonable expectation. And it's not unreasonable, but it does tend to lead to underspending. Now, before I say too much.
You want to say something?
No, just
Okay.
try to work out
Okay.
what to do.
Yes, so in an academic research sense, one of the groups I work with has looked at these minimum drawdowns and shown that people consider them to be an implied endorsement from the government. So the fact that there are minimum drawdowns, people think that's how much I should draw down rather than just guidance. And I guess secondly, in a really practical sense, my husband recently moved from accumulation to decumulation. And, you know, as a researcher, you always want to see how this works in practice. And so we had a look at the forms that you fill out. And actually the form you filled out to go to an account-based pension had two options: minimum drawdown or dollar amount. You know, and we're both trained economists, and we looked at dollar amount and thought, how much should we put there? I mean, not we, him, because it was his superannuation. And so that's often, I mean, that's driving what we see in the data. We see that people either take the minimum drawdown or the dollar amount, and unless they've been advised, which very few people are at retirement, they won't have done anything different.
And there are two anchors in the system. One is the age to retire for the age pension, and that affects behaviour. And the second thing is the minimum drawdown rate. And for many older people, they think, well, that's being frugal and sensible, and must be kind of a recommendation of government to do that. But the thing that, the other reason that I should mention that why people don't draw down is the precautionary savings idea. And quite often we'll talk about the smile in American finance, where people will end up having to pay more at a later age for things like health and aged care. In Australia, 90% of aged care is paid for by the government, and people quite often are very frugal for that reason, not realising and not being aware that most of those costs are picked up by the public purse.
Okay, and again, the age pension, the aged care support is means tested. And so even academics who look at this for a living find it difficult to work out how the means testing works. So ordinary people just wouldn't be able to do it. On this matter, I did some work with some Dutch colleagues, and we were trying to work out, you know, what was determining people's saving and spending patterns in retirement. So this was experimental work, not using data sets. And we ran experiments to try and get people to rank their preferences for saving and spending. And the number one in both countries was concern about health and aged care expenses. And both Australia and the Netherlands have very good publicly funded health systems. And the Netherlands spends more on aged care than any other OECD country. And so a lot of it is that the retirees themselves don't know and don't understand what level of public support is available. And so they're saving because they actually don't know what things are going to cost, but how much support they'll get from the government.
So we're talking about, on average, people don't tend to withdraw enough, but there's quite a bit of heterogeneity in the data actually in those withdrawal rates. So from what I understand, correct me if I'm wrong, from some of the studies, about 10% of individuals withdraw everything very quickly. Even in the asset allocation, you have about a third of individuals who put everything into cash. Jeremy, I think you did some work where, you did some work actually on that, on identifying the main dimensions of heterogeneity. Could you comment on which ones you believe are really the ones driving these heterogeneity in withdrawal rates?
Yeah, this is basically the model we use to work out the dimensionality of retirement preferences. And we think there's huge heterogeneity in terms of what people think is important in retirement. And so when we think about finding solutions for people that meet their retirement preferences, these are the dimensions we think about. So level of income, variability of income, how much variability are they willing to take in terms of their income, the investment risk they're willing to take, the access to capital that they have. And that's one of the big reasons people don't buy annuities, because they lose access to their capital in many annuity products, or they give up the bequest side. And for some people, the bequest is very important. For others, it's not important at all. I think the overwhelming evidence is that for most people, it's not that important. For say 30% of the population, it's quite important. So it's a very complex and individual decision about how to best provide yourself a retirement solution. And that's the dimensionality we use. The only other thing I'd like to point out is that people are making a lot of mistakes in terms of taking suboptimal decisions in terms of setting themselves up from retirement. And I think it comes back to the complexity of the system and to the lack of understanding. But we see major mistakes being made, and I'll just identify a few from the data we collect on age pensioners, because we have a service that helps people apply for the age pension. That is, it's so complex, people need a helping hand to actually apply for the age pension. And the mistakes we see people making is, first of all, on average, they're applying a year late for the age pension, which means that they miss out because there's no back pay. If you don't get your application in on time, you miss out and miss out your money. And so I find that appalling that we find that over a third of people are delaying well over a year. And only 40% say they applied on time. So that's a big mistake. We see big mistakes in people not switching from an accumulation mode to a decumulation mode. 30% of people over 66 are still in an accumulation account, which means they don't get tax-free treatment. So if you're in a pension phase, you get tax-free treatment, but 30% of people haven't moved to take advantage of that better situation. And we see huge amounts of people opting out of super and going into cash and sitting in cash. So there are all these evident problems, and we're still concerned about the lack of help for people to make better decisions.
And a lot of that comes back to advice, and 90% of retirees, I think, don't get advice. So that is a very big issue in the Australian environment.
So what's the room of the home in all this? We talk about heterogeneity. We talked about the home actually being a big asset. In fact, I mean, the home is the biggest asset of all in most cases.
It is in this age group particularly. And increasingly we're recognising this. And since 2012, there's a new sort of legislation around private equity release or reverse mortgage programs in Australia. There's a no net equity guarantee, so you're guaranteed to live in your home for the rest of your life. And there are quite strong restrictions on how much you draw against your home. But that's becoming increasingly popular for people who want to pay out debts at retirement, or who want to help their kids get into housing, or just to supplement their income on the private system. There's a government system, home equity asset scheme, which allows people over age pension age to be able to draw fairly modest amounts. It's not a credit product, but they can supplement their age pension, or they can take a very small lump sum out of that as well. But increasingly that's becoming a more important pillar because the value of that wealth has risen so much.
Okay. So I would say, yes, reverse mortgages in Australia, there's high growth, but it's high growth from incredibly low base. So, and I think again, it's like annuities. People don't know what the product is. They don't know what it can do for them, and they overestimate the risks of buying the product. So in the private system, yeah, fast growth from a very low base. The public system, we have a public reverse mortgage now called the Home Equity Access Scheme, which has been around, I understand, since the days of the Hawke government. Now, there's only about 6,500 active policies at the moment, out of what, I don't know, 3 or 4 million retiree homeowners. And, you know, it's something I think people just don't know about. So people at retirement, there's a lot of things they don't know about that they should. And one of the big problems is informing people and helping them understand what sort of things are available to help them in retirement. So I think this is a challenge for the government. I mean, this is a government scheme. The government's not very good at marketing these sorts of things. And even as researchers, if you want to find out about them, you've just got to Google government websites to try and find the information. It's not very user-friendly for retirees.
The only other thing I'd add is that I think people have used the home as the the measure of last resort. So it's for all this concern about precautionary thinking, people look at the home, not unreasonably, as the last resort. If everything falls apart, if I run out of other savings or other income, I can go to the house, I can downsize, or I can use it to pay for my aged care costs. And so I think it does serve an insurance policy and gives people peace of mind, but very often it gets left to the children who are very grateful because housing in Australia is worth a lot of money.
Sorry to interrupt again, but it's very interesting. So our group had organized a session in Shanghai some years ago at the Shanghai Forum. And the morning was household finance research, and the afternoon they picked the topic, policy topic. And the policy topic the Shanghai government was interested in was reverse mortgages, because they figured out they have so many homeowners, I mean, huge home ownership rates in China, and they didn't want to pay for pensions. So that's a great scheme. And we all had, you know, maybe I am disclosing a secret here, but we all had to Google reverse mortgages because, you know, we're doing household finance and we didn't know enough about it. So if you're complaining, you know, you guys are not using it enough, you know, I mean, in Europe and in many other countries, it's just not known at all. But one thing that came out from that discussion was that there are many parameters in these products and many choices, and that there was a serious concern of, you know, misreporting, of taking advantage of customers, et cetera, et cetera. And I want to ask you, I mean, is there such variety here? Is there any regulation? How are people dealing with that?
Yeah. One of the reasons why it's growing off a low base now is that prior to 2012, there were some really bad instances of people drawing too much equity out of their homes, being sold up and so forth. And that means that the term reverse mortgage in this country still has a bit of a bad feel about it. But the regulation we have now is 2012, very similar to the UK reverse mortgage legislation, and really very, very consumer friendly, and a very different thing. So it's going to take a while for people to get over the fact that this is a safe thing to do. And because of the value of houses, you can probably draw up to about 30% without there being too much of a concern. Canada is the other country that has had huge growth in reverse mortgages. So the legislative thing has been pretty well taken care of. There are one or two products out there that aren't exactly reverse mortgages, and there are some concerns that they need to be brought under this legislation as well, because as Jeremy says, this is a really complex problem for people to understand. And we've had a period where the asset growth has been much higher than the interest cost of taking out a reverse mortgage. So it's been very favourable. Now that's changed again, and people really need to understand it very well. They need very good advice.
So one theme that keeps coming back is the complexity of the system, the lack of awareness for some of the options. When we're looking at the recent policy pushes by the government, we're seeing quite a bit of an encouragement in giving advice, even the supers themselves providing advice. So we have the quality of advice review, we have the retirement income review that is encouraging the super to provide a guide directly to their members and about how to have more of a smooth and more generous lifetime pension. To what extent, in your view, is providing advice the solution to it all? I mean, can we maintain the same system, provide better advice, increase the supply of advice? Is that going to solve all the issues that we've been discussing so far?
Well, it's certainly not going to solve all the problems, but I think it can make a very significant dent in the problems. And we just have a totally unacceptable situation at the moment where advice about a very complex system is out of reach for average Australians. A typical cost of getting advice in Australia for retirement is around $3,000 to $5,000. And if you think about average balances, perhaps in the $200,000 range, that's just a very, very expensive impost. And we need to radically change the way we're delivering advice. And it's the result of a very strict regulation of advice in the wake of some advice scandals, which has caused the government to really tighten up the compliance and drive many of the advisors out of the market. So the number of financial advisors in Australia has dropped from about 28,000 to about 15,000 over the course of 3 years. So we have a real supply crunch and a demand response in terms of the demographic, the aging population in Australia. So we have a total mismatch in the marketplace, and we need new solutions for how we provide advice, particularly about retirement, which, as we've all talked about, is this very complex situation. So we need to change the settings, and that's what the Quality of Advice Review is all about. And we're waiting with bated breath to see what will come out of that. And we don't know, except that we think that super funds will get an encouragement to offer more advice and help to their members, and that we will be able to use digital means, in particular, to help lower the cost of providing that advice. So it's exciting times ahead, but there's a lot to be done.
I really think when you talk about advice too, you should talk about information, guidance and advice. There are so many good digital tools that you can use to advise people through their accumulation journey and have them prepared their retirement income projections to think about what am I going to have when I retire, not just the nest egg. So I think the sort of tools that you can use in funds are very cost effective for large funds with people with low balances, and also provide that kind of information and guidance. So full-on advice becomes less necessary at the end.
Yeah, I was going to say almost the same thing. People just need to know things. So it's not necessarily they need a detailed, lifetime advice plan, but they just need to know things. And I think this may be getting on to your next slide, but people need to, from an early time of contributing, think about superannuation in an income frame rather than an accumulation frame. And I think because in Australia, we don't actually think about replacement rates. Ordinary people would never talk about replacement rates. So as academics and policymakers, we put up charts saying, low income people have a replacement rate over 100, and in the middle it's 70, and at the upper end it's 40%. But that's not part of people's conversation. You don't think, am I going to have a high enough replacement rate in retirement? And you would never see it on a pension fund statement. I'm not advocating we should talk about replacement rates, but we need to talk about income in retirement rather than just building a lump sum. And once we talk about income in retirement, people may then think about what can an annuity give me, or a retirement product give me, or taking income out of my house. But unless we start talking about income, all of these things are just irrelevant to people.
Well, so let's talk more about that, because you've done a study on this. With CBUS, going back to the point that if we focus a lot on the capital accumulation, we have a hard time converting it into income. So you've had this study that you did recently with CBUS, one of the supers, very much focused on the construction and mining sectors. And in that study, the whole idea was to help people understand what their capital meant in terms of income. Now, of course, there's a projection that is involved here. So there is it's an estimate, not a deterministic statement. But could you speak perhaps about that study? What the what the study did, I guess, in a few words, but also what the implications were in terms of perhaps getting more engagement out of the members. And perhaps, did we see that this study helped people to better understand what their capital meant into income and perhaps started withdrawing more actively?
So the context here is this: the Australian regulator actually has regulations around retirement estimates and allows funds, if they want, to give their members estimates of both the account balance and an income stream at retirement. And CBUS was one of the first funds to actually do this. And so CBUS started doing this about a decade ago. So it wasn't a study that we designed with CBUS, but we were fortunate enough to have a good relationship with CBUS and have access to their data to see what the membership had actually done, over a period with these retirement estimates. As I said, the estimates are both, I think there's a picture up there. So typically on a superannuation member statement, you get the current balance. And most people wouldn't have a clue what that meant in retirement or what it meant in terms of income. And so CBUS followed the government regulations, and members were given an additional statement that had a projection of both the account balance at retirement and the income at retirement, assuming they got a certain age pension. And this is where these things become difficult. You can't give people accurate projections because you don't know what the age pension is going to be. And if I recall it, initially they were assuming people got half the married rate of age pension. And so with my great colleague Susan Thorpe and some others, we were fortunate enough to be able to analyse this data, like a field study, and found that it certainly did increase voluntary contributions. And so in years after people first saw the statement, and then they would get it in repeated years, we saw a significant increase in voluntary contributions. Now, we have a complicated system here where some voluntary contributions are tax preferred and others aren't. Interestingly, we saw an increase in tax preferred contributions. So, people were engaging and sort of increasing their contributions. We also saw in the first couple of years around a 30% increase in interaction with the superannuation fund itself. And this is what we want. We want people to interact with the fund. We've been fortunate enough to follow this CBUS data now over a large number of years, and this persists so that people are continuing to increase their voluntary contributions.
Well,
I'd just like to add on that, very much appreciate that study, Hazel, and it's absolutely what you'd expect. And it's hopefully where the industry is going to go, encouraged by the Retirement Income Covenant. So the Retirement Income Covenant, I think, is an important piece of legislation that is encouraging super funds to think about the retirement phase and not just the accumulation phase. For too long, the industry focused on helping people build assets because they were like businesses. They were trying to build their own flows of assets, and they were thinking of themselves as product providers. We're providing a superannuation accumulation product. But the purpose of the Retirement Income Covenant was to remind funds that it's really all about retirement income. And that's what the purpose of superannuation has got to be about. And we need to move away from that balance focus to the retirement income focus. And I think the Hazel study really shows that retirement income forecasts help do that.
So let's talk more about some of the retirement income forecasts that you had developed back at Vanguard. Because what was interesting there, and this is what you see here on this chart, is it's not just about providing one forecast, which is an average, of course, of what can be expected, but it's also, as soon as you start giving one number, it starts becoming a deterministic a projection. But instead, what was interesting in the retirement income builder that you have at Vanguard is you provide multiple scenarios. In fact, what you see here with the different shades of green, I guess, is whatever is something you can get with a reasonable degree of certainty. And then depending on the scenarios, you can have that top up with some degree of lower degree of certainty, which did that help people to get a better understanding of the risk in their income they would expect to get?
Yeah, I really think it does. I mean, I think deterministic forecasts, which assume one rate of return are really a good start, but they're really limited and flawed in the sense that they don't give people who are working in a market-based system, investment-based system, they don't give an understanding of the range of outcomes that are possible in given our equity and bond markets. So you really need to give people an understanding of the range of outcomes they may get. And deterministic forecasts don't do that at all. And in fact, they tend to encourage people to take more risk because you invest in a higher growth asset allocation, your return assumption is assumed to be higher. Therefore, you automatically get a higher rate of return, higher income. And that's just not realistic. That may happen, but there's no guarantees. And so, although stochastic forecasts are difficult for people to understand, we need to help people understand there is a range of outcomes.
I love a coloured diagram like that. I think it conveys more than many pages of writing and calculation could to an individual. I just think that's a great way of distilling information.
And since I think we're talking to international academics here, I can't see you all, but I'm sure you're behind your computers. Now, this is a really interesting research area in how to present this information to people in a way that they understand. So it'd be really nice to do field experiments here, and Vanguard chart looks really nice, but it'd be really nice to test how people understand this and whether there's other ways of presenting the information that help different people of different financial capabilities to actually understand these things.
Well, so building on that and speaking more about from a research perspective, so we've talked about testing different information models. Can we also take a step back and think about what should an optimal decumulation plan look like? And that's a hard question. And there's not a ton of research on this. We've focused a lot of our time as academics on the accumulation path and the optimal asset allocation. If we start thinking about the optimal decumulation path, we have to think about the drawdown rate, the degree of the drawdown rate, the timing of it, maybe the flexibility that people might want to have in addition. We have to think about the asset allocation as well, of course, in the meantime. Of course, that's a hard loaded question that I have here, but in your view, perhaps conceptually, are there key aspects that we should think about that would characterize an optimal decumulation plan?
Okay, I'll start. Okay, I think in Australia's context, where we have a means tested age pension, optimal decumulation depends where you are on the wealth distribution. And so, there's going to be people at the bottom end who are full age pensioners who have a little bit of superannuation. And it's probably better for them to take a lump sum actually, or to have an account-based pension and have flexibility, because the age pension already gives them longevity insurance, insurance against investment risk, insurance against inflation risk. Because we probably haven't mentioned this, but the age pension in Australia is indexed to the highest of three indexes. That's the CPI, average male ordinary time wages, and something called a pension beneficiary index, which is a CPI but a basket of goods for pensioners. So it's pretty well indexed. And what's the optimal decumulation? Well, for some people, probably just the age pension and having an account-based pension. People in the middle who are on part pensioners, that's difficult again. People at the top who are fully self-funded, this is probably where you want some sort of hybrid product where you've got some annuitisation and some flexibility. So in my view, this is a really difficult question. For anyone who's interested, we have a paper on this, of course, in the economic record, because some of these issues the rest of the world haven't been particularly interested in. The overlay of an of a means-tested age pension and a DC system is not that prevalent in other countries. And what we wanted to find out was what's the optimal amount of annuitisation. And so in a life cycle model, a fairly standard life cycle model, across the whole, if we didn't have an age pension, it was around 38% should be annuitised. If we have an age pension there and we didn't have a consumption floor, probably the first people with the first $200,000 of super shouldn't annuitise at all, and other people should annuitise around 25%. So I guess what we've found here is, you know, where you are in the wealth distribution is important, and you probably shouldn't annuitise everything.
I certainly agree with that. And certainly when we did the retirement income review, it was always about the low income earners, the bottom 30%, the middle 40%, and then the top 20%. Circumstances are different on each one. But it is very interesting that most of our discussion today has been about that refocusing from accumulation to decumulation. And we had a financial system inquiry in 2014 that said we really need to do that, and we really need to have better retirement products, comprehensive income product for retirement, they suggested. So now, nearly 10 years later, we're just really getting around to it. And the Retirement Income Covenant came into force on the 1st of July 2022. So trustees of super funds now have to put that into action, develop how they're going to help their members go through to retirement. And we're looking for changes to advice to help with the very important task of providing advice, whether it's digital, hybrid or whatever, to individuals. But I guess the thing that keeps coming out is there's so much behavioural work to do. How do people respond? How do they make difficult decisions? And how do we help them to get their house in order? It's not just purely advice, but it's information, guidance and advice, which is partly about the funds, but it's much broader in society, I think.
So I really support the comments of both my esteemed colleagues here, and but would go back to the point about heterogeneity in retirement and that everyone is different. Everyone is different. I think Hazel points out the importance of wealth in driving heterogeneity, but it's also about preferences and what is important to people. And I think less in terms of a ideal product and more in terms of an ideal service. You know, there's been too much focus on product solutions where it's going to be very difficult, I think, to find default product solutions that really work for a spectrum of the superannuation membership. Instead, I think we should be focusing on service solutions and helping people work out how to get their ideal, what I call retirement salary, out of the various sources of income that they have available to them. How can we help them get the best solution for them, the one that makes most sense, given their preferences and their situation? And I think that's the fruitful area of development that I'm really interested in.
So products do exist. We're actually plenty of products, even annuities, tontine-like solutions do exist, but they haven't historically been perhaps the most successful. And this is not, I mean, it goes back to what Michael was saying earlier. This is not unique to Australia itself. There's a low demand for annuities in general. We don't talk about tontines. It's we relabel them. And what, in your view, have been the key hurdles in getting some of these past products to become successful?
Well, I'd start with people's unwillingness to give up the access to their capital and their concern about dying early and giving it up, on top of the lack of understanding of the benefits of mortality credits, which are very powerful, but it's a very hard concept to understand. So I think nothing unique about Australia in this particular.
There's one aspect, regulatory aspect, about the amount of capital you have to back an annuity type product in Australia, which is very high compared with international standards, and that is an issue.
Yeah, I would say it's actually, it's three-pronged. It's demand, supply and regulatory. It's complicated. So on the demand side, there's just lack of awareness of products. People don't know they exist, and even if they do know they exist, they don't understand them. On the supply side, well, I guess it's very hard for people, because of the regulatory requirements, it's very hard for people to launch a product unless they know they're going to get good sales. And then the superannuation funds themselves, they've just been very slow at including any sort of product other than account-based pension on their product menus. And that's where most people are. They belong to a super fund and they probably look to their super fund to help them. And this is where the retirement income covenant will help, because as well as requiring funds to guide and inform and give advice, they will also hopefully extend their product menu so that people become familiar with different products.
And the regulator will look at member outcomes from the retirement income review. So there's a real stick, as you might say, to be able to do that.
And I would say this probably sounds like a really roundabout way to get people to think about products. I mean, other options, you could mandate and require that everybody annuitise something. You could have defaults or personalised defaults or different defaults for different types of people. Some of you could probably say, why don't you have tax incentives to encourage people to buy these products? But a government without much foresight got rid of the taxation of retirement benefits about 15 years ago. And so the tax incentive option has gone as well. So it is a really tricky problem how to get people into these products.
So what do you think moving forward is going to be the game changer? Could it be, and we've perhaps new products or new services? QSuper has been quite proactive in developing a tontine-like type of product that is embedded actually as a service now in the decumulation phase. Could it be digital innovation? We talked about financial advice, making it more accessible, cheaper. Is it perhaps the arrival of new digital platforms that could be very much of a, again, a complete game changer in the way individuals approach decumulation? Or could it be perhaps government policy? Perhaps new policies such as you mentioned, the retirement income covenant can potentially be the impetus for change. What in your view is going to be the game changer in the next 5 years?
I think there's two pieces of policy development which are really important, and one is the quality of advice review, which the outcome hopefully should be increasing access to advice for a much larger part of the population. And the other is the retirement income covenant. So it's in its very early days, and the regulator in the first instance has asked funds to develop a covenant, and they give them, I guess, feedback on the covenant. But I'm sure over time they're going to be a lot more prescriptive on what they want funds to do with their retirement income strategy. So I see though, I mean, those are two things which are a big change over the last 25 or 30 years. And funds are now required by the regulator to think about decumulation and to think about outcomes for members during decumulation.
Yeah, I think digital, there's a lot to do with our solution because we have great economies of scale now in our funds. There's been a lot of consolidation. They're becoming very large. They're getting to the point where they can't afford to do personal advice, and digital information, guidance and advice is a very good solution. I think in about 10 years' time, our super funds will all have a platform with a whole range of products in it. They might be aged care products, they might be home equity products, as well as annuity type products. And I think it will become the go-to place for people moving into retirement.
I think I'll add the marketplace and competition and the importance of retaining members for a super fund into the retirement phase. I mean, it's in their retirement years that people have the money, and you know these super funds have had these clients all along through their accumulation phase, and now they have their money, and the economics drive the need to keep those members into retirement and through retirement. So I think competition in a consolidating, intensifying environment with an aging population and huge demographic shift to older population will force funds to compete to do a better job, backed by the retirement income covenant and backed by changes in the quality of advice review, advice regulations. And I think digital will have a lot to do with it, because we all use Google Maps now to get to where we want to go. Although I can tell you a story about trying to get to a golf course in Ireland one time, which wouldn't put Google Maps in the best light. But ultimately, we're going to use technology backed by, I think, human help or hybrid solutions in the near term to really help people get their arms around this very complex problem of getting the retirement lifestyle they need. It's a very challenging problem, but they need help. So humans and digital have to get together and make it happen.
Well, that was super interesting. Thank you. That concludes the first part of this discussion. Thank you so much for sharing these insights. We're going to go in, if this works, doesn't matter, it's just a Q&A. We're going to go more into now of a Q&A type of mode where, like, every one of you, if you have questions, any comments, I'd love to hear from you. But before we do, actually have perhaps a question for the panelists, the last question, which is that, well, we have researchers both in person as well as virtual in the room who are experts in household finance in different countries around the world. Are there things that you would like to know from other countries about what they're doing, perhaps that would be useful to Australia? And relatedly, and we've already talked about that partly, is where would you like research to be done, really the high impact research that can help in the field?
So I will start. I'll start if that's okay. Okay, I'd like to know from other countries what happens in defined contribution schemes, what happens at retirement? So are there mandatory requirements for people to take annuities? Are there defaults? Are there tax incentives? So what's actually happening in other countries who have defined contribution systems at retirement? In terms of academic research, there's an awful lot of academic research on this, and there's life cycle models which look at reasons why people annuitise less than we think they should or don't annuitise at all. So there's stuff on medical costs, and people's subjective life expectancy is lower, and people have present bias, and we know what all the problems are. And there's behavioural research that tells us how we should explain annuities as consumption products and not income products, and a whole range of sort of things identifying the problems. But I'd like to see some work on the solutions. So how should we describe these products? How do we get people to take them up? What sort of digital tools work for people of different levels of financial literacy? So it'd be really nice to have real life field studies, or experimental studies maybe to start with, but field studies and getting real data and seeing how to help people in the real world, because I think we do know what all the problems are.
Hear, hear.
Here. Yeah, there really isn't that much help in terms of working out the behavioral side of how people will respond in a choice defined contribution type environment where the responsibility is on them. So, real tests and the a good case study that Hazel used was the CBUS statements, forecast on statements study. That's a really good example. But also how people age and how their financial needs change, financial gerontology, and really how to deal with issues of mental decline and all the issues, how to deal with aged care, unexpected expenditures, et cetera, lots of issues, very much in the household finance, behavioral finance type area.
Mm. Yeah, I think cognitive decline, particularly we talked about self-managed super funds in Australia. How do you deal with the fact that as we get older, we tend to get more confident and less capable? How do we gently and carefully persuade people it's time to wind that kind of thing up.
Great. Well, thank you. Those of you in the room will pass you on the microphone. If you have a question this way, anyone can hear. Those of you virtual, if you can raise your digital hand, then we'll call upon you. You can unmute yourself. And this way we can get everyone to participate.
Maybe I start with a question. How much information is there for people to find out how much they're going to get, you know, when they retire in the form of pension? Because you know, if I think of myself, I'm as boring as hell. I mean, I'm a civil servant in Germany, right? And my job is guaranteed, and it's a formula, it's a defined benefit pension. And I'm 3 years from mandatory retirement. I should know exactly how much I'm going to make. And the answer is, it's very difficult to find out. And if I ask, I have the system, I have to have a reason to ask the system. Otherwise, the system doesn't respond to me. Okay. And the system has responded with an estimate, but not. So how easy is it here in Australia to find out, you know, for more complicated cases also, not the civil servants, but for more complicated cases, how much they are due? Yeah.
Well, I think it's very difficult to actually work it out. I mean, let's start with the first pillar. Working out how much you're entitled to under the age pension system is very difficult because it's tested on both your assets and your income. And one of the things my company does is actually offer an age pension eligibility calculator, but that's a rarity, and everyone should have access to that. The government's own age pension estimates are terrible, very difficult to use. And so start with that. That's very difficult. And then you have to work out what can be available from your super and other sources. And many super funds now are offering retirement estimates. And so it is really improving, but we still have a long way to go to help people really understand it. Often unrealistic assumptions are used. And so we have a long way to go, but we have the steps in place. Hopefully we can make progress.
I would say also with the DC system compared to a DB system, you could have a different rate of return depending on your asset allocation and also market conditions. You can change your voluntary contributions. We have a much greater choice of retirement age. We can retire basically when we want. We can access our superannuation from age 60. So even though the public pension doesn't come in until 66, moving up to 67, we can find out, there's calculators. So the government has a website called Money Smart, and there's calculators where we can put things in and estimate what we may have at retirement. But that wouldn't be able to work out what our public pension eligibility would be, because public pension it's tested against a broad range of income and assets, but just about everything other than our house. So it is very difficult to find out.
So this has been very interesting. I have two short questions. One is, the reason they're called super funds, is it a marketing thing or is it something more important?
Why are they called super funds? Why are they called super funds? It's the word superannuation is.
Yeah, but super funds implies that it's a really good investment, you see. And I say that because I wrote a paper in Cyprus. They called some bonds value bonds, and they lost 100% of their capital.
Superannuation
It does not have to do with Superman. It has to do with the word superannuation. I don't know the exact etymology, but I think it
means something quite dismal, quite the opposite to super.
Yeah, but annuation is the important part of the word. So bringing in an annual stream of retirement.
But the super implies for somebody who reads it in the street that it's really, I'm putting my money to a super thing, right?
Yeah. It's a synonym for retirement. It should be a synonym for retirement.
And can I say, it is a pretty good system. I'm very aware that when we started doing the Mercer Index, now the Mercer CFA Index, that we were doing a review of super and we all knew everything that was wrong with it. So we were very surprised when it first came out in 2010. I think we had 11 countries and I think we were second. This latest one came out, there's 44 countries and we're number 6. So when we have a discussion like this where we want to talk about all the things that aren't good, there are things that are very good as well. And our level of adequacy is pretty good. Our level of integrity of the system and the sustainability of the system are pretty good. But obviously there are things we'd like to fix.
Yeah, I'd say there's a lot of good things about the system. So unlike many other OECD countries, we didn't go along the path of a public contributory pension, which end up with huge liabilities these days. So we don't have one of those. Our public pension is it's taxpayer funded, yes. And also we don't have the problem in the US about are we saving enough, because we have a fairly high contributory rate that has very broad coverage. So yeah, there are good things about it. But there's problems with it, which some of us have been talking about for the last 30 years that have taken a long time to resolve.
Okay, so they are super, I guess. So can you say something about the regulatory infrastructure as well and how it has evolved over time?
Yeah, I think our current structure came from a review in 1996, the Wallace inquiry. And I think it's been very interesting that, as with regulatory systems around the world, things have changed a bit. Our regulators used to think only in terms of the efficiency and stability of the system, but increasingly they're looking at consumer outcomes. So one of the most interesting things to me from APRA, which is the major regulator that looks after banks, insurance and superannuation, is that focus on what's the outcome for consumers. And I think it's been a really good change. It makes regulation more complex, of course, but we are now concerned with the individual more than the overall institution itself, as well as,
I would say actually one thing that's been interesting is the change in the structure of the industry. So going back 20, 25 years, you know, there would be 4,000 regulated funds. So every company had a corporate fund. There were lots of public sector funds, local government funds. The large industry funds came in 30 odd years ago. There was a lot of funds in the retail sector, and there's been a lot of consolidation. And this is good because we've got big funds with scale that can do things. And we now have a performance test where, you know, funds need to have achieved a relative performance, meet a relative performance benchmark as well. So I think lots of things have changed that are benefiting members.
Thank you very much for the discussion. I just wanted to ask a question about optimal decumulation and advice around decumulation, what Jeremy was talking about. So you would think that in sort of a standard model that optimal accumulation would be a function of the available decumulation plans, right? So let's say that if the premise is that people are over saving or not chunking it out in the rest of their life in the right way, that this could potentially be that you need to save less into these funds as you're living your life. Could you expect that super funds, being businesses and caring a lot about, you know, how much contribution is in their funds, this is essentially float for the business, right? To offer advice that could potentially lower their contribution. Like, is this a principal agent issue that could be solved in your perspective?
It's a really important point, because the key thing about superannuation is that it should smooth income over your lifetime. There is absolutely no point, if you're a low income earner, saving too much for retirement and going without during your working life. And one of the things that has been quite detrimental, I think, is that we have had some absolute targets for what you need in retirement, like $1 million, which is completely unrealistic for people who are at the lower end of the income scale. And when we talk about the low income people, we mean people with gross incomes of less than about 56,000 a year. So I did do some work with a major super fund not long ago called about a retirement confidence index. And it was so remarkable that the group of people leading up to retirement were very nervous and unsettled and worried about not having enough money. People who got into retirement really felt quite comfortable. And there's far less financial stress in retirees than there is in working age people. So the point you're talking about is a tricky one, isn't it? Because obviously it's in the interest of super funds to encourage more and more contributions. So that's a good question. I don't know the answer.
Yeah, that is an interesting question. And in the context of some of the CBUS work that we were doing, CBUS in their statements to members didn't just have a page with a number on saying this is what your projected balance would be. It also had some information and some calls to action. And so at one stage, it's actually not allowed to do this anymore because the regulations have changed, but it used to have different messaging for different types of members depending on their account balance and their projected income. And so for people with very low account balances, there'd be a calls for action about, have you thought about contributing more? For people who were doing pretty well, and pretty well, I think, was defined as something, will give them something in excess of a benchmark that we have, the ASFA comfortable benchmark. The call for action wouldn't be necessarily be about contribute more, but it would be, have you thought about changing your asset allocation, or have you, directing them to different parts of a website rather than forcing them to contribute more. And so, but it is interesting, because it is in their interest, it's in the super fund's interest to get as much money into the fund as possible. And I thought these differential sort of messages that were going out to different parts of the membership was quite interesting. So it wasn't encouraging everybody to contribute more.
Along the same lines, to what extent for a while super funds have not had tons of incentives to focus on decumulation? Because by definition, decumulation means money goes away.
That's the interesting thing that Jeremy mentioned before. Your member is most valuable to you at the point of retirement because their balances are at the highest. And we've seen a lot of inertia about moving to a retirement focus from the funds because that concentration on accumulation has been so great. So it doesn't make good business sense, does it? But I think that message is getting through, as Jeremy said, that you retain your customers going into retirement when their balances are higher.
And I would say also in the regulatory frameworks, superannuation funds are required to act in members' best interests. And also for the retirement covenant, they have to, I can't remember the exact wording, but they have to pay attention to retirement outcomes or members' retirement outcomes. And the regulator is keeping a very close eye on this. And so they would probably, if funds weren't offering a range of products or assistance for people to help them draw down, I'm sure the regulator will be onto them. Yeah.
Yeah, I just want to ask a question about the lack of financial advice, and in particular, how financial advice is offered here in Australia. You said that they have to pay quite a bit of money to get that financial advice. So what is the regulatory framework around it?
Well, it's a very highly regulated environment for financial advice. We had a series of scandals which related to conflicted remuneration and then to sales practices. And we had a whole inquiry, which was quite extremely public and embarrassing. And there were billions of dollars of compensation paid in the 2019. So since then, the regulation has been tightened, and now we're concerned about it having gone too far and driving too many financial advisors out of the business, and therefore not being affordable to consumers and getting to a price tag that is just not manageable for consumers. So I think everyone recognizes we have a system that needs to change. And we've just now done a one-year review of the system and with recommendations done to make changes to the system. And so we're waiting to see what recommendations will be endorsed by the government.
Yeah, apart from excessive regulation, there's also been tremendous risk aversion. So even things that funds could probably do, they're too nervous to do until it's clarified in the legislation. And the person conducting the review gave an example of someone ringing their fund and saying, look, I've got some spare money. I think I'd like to put it into my super fund. Should I do that? And it was a pretty simple question, really. And the person at the fund could really say, well, have you got any debts? You probably should pay off your debts first. And if you've done that, by all means, put money in your super. But funds won't give that level of quite simple advice now because of huge risk aversion and the need for greater clarity on that.
Is the regulation like abolishing like commissions or asking that you have to act in the interest of the client, and then that's why, yeah.
Well, actually, we abolished commissions some time ago, and quite a few of the scandals that Jeremy mentioned were before that legislation took place. Quite a lot of it was historical stuff. So it has been evolving gradually over time, but the complexity of the legislation, the overlap, the different definitions, all of that is also being reviewed because it's just, we are a very bureaucratic country. We do love a rule or two, and it's tied us in knots.
Yeah, so I think one of the things, even a small piece of advice like making an extra contribution was treated like, you know, a large financial plan. And so you still needed to have qualifications to give that advice. You had to give a detailed statement of advice. And so those sorts of things are expensive. And if we were talking earlier about retirement drawdowns and why does everybody just draw down the minimum rate? And one of the things that funds were very reluctant to do was to give people any personal advice in that. And so, you know, if I got the form and it said tick the box of the minimum drawdown or ticks the dollar box, if I phoned up my fund or I went to an office front to talk to my fund, they wouldn't be able to help me think about what should be an alternative drawdown rate because that would be considered financial advice. So I'd have to go to a financial advisor to help me work out whether to take 4% when I'm age 65 or 10%. So hopefully with the financial advice review, superannuation funds themselves will be able to help people with these sorts of decisions where there's personal information involved.
Yes, something on this. I mean, a solution that countries like Germany, for example, found useful is has been to define or to declare fee-only advisors. So financial advisors who have nothing to do with sales, right? But then you have to declare it and you have to stick to it and you have to be independent of the sales operations. Is this possible here? Has this been done or implemented?
That's our environment today. We have predominance of fee-only financial advisors, and commissions are banned except on life insurance. So we haven't had commissions since 2014, I think, 2014. So it's been quite a strong move to a very transparent system with very strong fee disclosure, but it remains incredibly complex and overburdened.
And increasingly procedural. So it's been more about crossing the I's, dotting the T's and focusing on the issue, I think.
And I think also it's also about public awareness again. So when you talk about financial advice, the public thinks about a $3,000 or $4,000 plan, rather than the ability to get single item advice, on a fee only basis for several $100s. But I suspect a lot of people don't realise they can do that.
So thank you for a very interesting discussion. In the earlier part of this discussion, you talked about these programs that are provided publicly for low-income people after retirement, and the fact that many people actually don't use it, right? Is there a chance that part of it is by design, in the sense that, like, from the government's perspective, right? It's the best of both worlds, in a sense that, like, look, we provide all these nice programs, but not many people use it, so we don't have to pay for it. It's kind of great, actually, right? So what is the issue of political economy here, right? Or the design. Do you think that could be part of because the issue of marketing, sure, but do they really want to do that? Like,
I was going to say, I absolutely agree with that, with the public version of a reverse mortgage, because that's intimately linked to the age pension. And so the amount that you can draw down in the public scheme, the maximum is 1.5 times the age pension. If you're a full age pensioner, you can get half the age pension. If you're not on the pension at all, you can get 1.5 times the age pension in income. Now, if the government promoted that, then that's an indication that perhaps the age pension is not enough and you've got to use your own house. So it's a political economy question there, that, the government has it on the shelf, but they're not promoting it because, yeah.
And just on the age pension itself, it's remarkable how little the government does to promote that, or to let people know they should be applying for that when they're age eligible. It's remarkable how little they do. And I'll just contrast my own experience. I spent 21 years living in the US, and I get notices every 6 months from the Social Security Department in the US about when I'm going to be entitled to Social Security. And here I get nothing. Nothing from the Australian government on my entitlements. I do get a nice thank you letter each year on the taxes I paid, which I appreciate, but that's about it.
Returning to annuities for a moment, I recently attended a conference where a senior industry representative claimed that insurance providers were very reluctant to offer annuities, in particular deferred annuities, which start at a late age, say 85 plus or so, because they were unwilling to bear the longevity risk, the macro longevity risk. Think about breakthrough in cancer treatment or things like that. So I was a bit surprised by that, because first of all, there's a natural hedge. Bad news for annuities is good news for life insurance. So if you offer both products, you're fine. So could it be that the absence of a functioning annuity market is partly supply driven? It's not that there's lack of demand, but there's lack of supply.
Yeah, I think I was going to say that earlier and I got sidetracked. But yeah, I see the annuity market problem as a demand side issue and a supply side issue. The insurers just don't want to offer the products. And until recently, a regulatory issue, because there was regulation on the types of products that could be offered, but that's actually disappeared over the last few years. But yeah, I do think it's hugely a supply side issue there as well.
And in fact, there is that issue of an incentive there. If you're on the age pension and you commit some of your capital to an annuity, you're favourably treated in the assets test.
And I doubt if anyone could work out, any ordinary person, retiree, could work out what that benefit would be.
But I guess a follow-up question on that is, to what extent the government is in a good position to offer that longevity hedge? So right now it has the age pension, which is means tested, but to what extent, instead of, let's say, increasing the level of the age pension, you just reshift it, where you start providing, which I guess it does already, because you're saying that the level of the age pension does increase with age. And so
actually, the level doesn't increase with age, but the what happens is the number of people who are eligible for it increase with age, because as they age, their private assets run down, their non-housing assets run down. And so people, you know, retiring at 66, 67 still have superannuation and financial assets. And so they're eligible, they're either not eligible or they get a small part pension. But as they age, they're more likely to move to a full age pension. So the amount of the pension doesn't change. It's just the eligibility that changes.
And older people in our system really haven't had the benefit of superannuation over their full working lives. So their super balances are very small at this stage.
I think many people in our consumer market would prefer a universal age pension, but I don't think they really understand how much it would cost to deliver a universal age pension. I think a potential solution is to offer a universal age pension or a higher age pension at an older age. And I don't think there's been much discussion of that, but I think that's a possibility. But when we survey our clients, we're amazed by the desire for a universal age pension that is easier to understand. But I just don't see it in the cards.
I'm not sure it culturally fits here. Nobody wants to pay wealthy people a pension.
No, we did almost get there, I think, in the 60s and 70s, where the means tests were changed, and there was a risk that I think Menzies, who was a previous Prime Minister, would have been eligible for the age pension. A wealthy Prime Minister from one of the wealthiest electorates in Victoria. So, you know, those Australians don't accept those sorts of things.
Yeah, Alex. I can ask something about this. So in this age pension, is it correct that let's say I'm a wealthy person, I'm about to retire, I just put all my financial wealth to repay my house, and then I get the pension and I have it forever, and then I can withdraw equity, home equity? Is that a possible solution in this?
Yes, you could do that.
That doesn't sound very Australian then, to use your words.
Well, I guess home ownership is a very Australian thing too. Yes.
Yeah, but I mean, I can optimize this system, right? I can, if I had to write a program, I would say the optimal thing for me is to actually, and this happens, there are papers where, you know, why is social security low in many countries? Because you want to incentivize at least some saving. You know, you can crowd out private saving through public saving. So in this case, you can really optimize by just doing the wrong thing, quote unquote, by doing what's privately optimal for you. Right.
And then what you would do probably is sell your house just before you die, because owner-occupier home is exempt from capital gains tax as well.
And if we just look at the whole system logically, the first thing you would do is include the home in the assets test. There is no politician born in Australia who would be prepared to put that forward. It would be a little bit like France, I think, if home was included in the assets test.
Okay, another related question then. Is there an inheritance tax in Australia? Inheritance tax?
Inheritance, no, there's
nothing. Nothing,
No.
zero? Okay. Okay, so that makes it even worse, yeah.
All right, well, let's give a big round of applause to our
I was not planning to say anything at the end, but I have to. Okay, so let me go here so that I'm visible. First of all, you know, I've been to many academic conferences in my life and to many panel discussions. I've participated in a number of panel discussions. I've organized a number of panel discussions. I have never seen such a smoothly running, interesting discussion based on a narrative. I have seen it in private sector, you know, discussions or panels, but never in an academic setup. And I think Sebastien and our three distinguished participants are to thank and to admire for that. This was very impressive. And the last thing I want to say is to thank the 0th person behind all of this, Kaveh Majlesi, there from Monash Business School, who got us here and who organized and set up the panel before Sebastien could get his hands on you and not let you rest for some time, from what I understand. So thanks to everybody.